So here we are. The air is finally coming out of the market. In just 4 weeks, from the end of February to the end of March, the S&P 500 dropped 34% in what was the quickest drop in US market history. As I record this video, we have rallied 28% and we are down just 15% from the February highs. The market has rallied despite the fact that we're surrounded by negative news and the likelihood it's going to continue. I mean, half the world is in lockdown. Companies are not producing, companies are not earning, and the number of cases is growing and growing. Job losses are at an all-time high, and most Americans don't even have $400 saved in an emergency fund. Can we make a quick V-shaped recovery and go on as normal? Or are we in for a much worse prolonged depression? Well, I've been doing some digging, so let's get into what I found out. So as always, we have the doomsdayers shouting at the top of their voices that the economic collapse is coming. And watching them is like watching Jerry Springer. You know you shouldn't and it's turning your brain to mush, but you just can't help yourself. But we've grown accustomed to just ignoring them. However, this time it's different because we have the likes of Ray Dalio comparing what's coming to the Great Depression of 1929. And when Ray Dalio starts doomsdaying, you know you better start listening. Others say we're in for hyperinflation like Venezuela or Argentina, where we're going to be left with nothing but monopoly money. And if that's not bad enough, some people are even saying that we're going to have deflation first and then hyperinflation. Or worse yet, an endless abyss of stagflation. But instead of getting all flustered, I look to Mr. Howard Marks for a balanced opinion by somebody that I trust. And in case you didn't know, Howard Marks is a very successful value investor who runs Oak Tree Capital Management, and he's wrote 2 fantastic books. The Most Important Thing and Mastering the Market Cycle. Highly recommend both of them, especially this one. It's brilliant. He also regularly comments on the market through memos available from Oak Tree's website. In his latest raft of memos, he's been a voice of reason through all this madness. In his memo, Which Way Now, Howard outlines his bull and bear case for how things can play out. And in his usual fashion, he doesn't make any statements or claim to know about the future, but he asks a lot of thought-provoking questions and talks in terms of probabilities instead of absolutes. And this is a true sign of someone whose opinion is worth your time. In Howard's bull case, he outlines the success of some of the earlier countries in flattening the curve. Based on his data, he proposes that the number of new virus cases will be brought under control within 3 months, and the economy thus can go back to normality. News of a better future and indicators of early success will drive the market to a quick recovery. Massive stimulus by the Fed and the Treasury will successfully bring the market out of life support and back into a functioning economy. All this happens quick enough so that businesses can weather the storm and come back stronger than ever, leaving us with stronger earnings in 2021 than even 2019. In Howard's bear case, he outlines the slow reaction by a lot of Western countries to implement social distancing and testing. Much of these actions were only suggestions as opposed to strict social distancing policy. This is in stark contrast to other countries who managed to get the number of new cases under control quickly by implementing more draconian measures. A clear lack of testing is also a major concern. All this leads Howard to believe that headlines could get a lot worse from here on in. The economy will contract at a massive rate, leading to gross unemployment and a shortage of goods and services. Some forecasters even predict a Q2 GDP decline of 15 to 30%. Compare this to the worst GDP decline in history of 10% during the 1950s. Can the governments really manage to keep all these businesses afloat during such a contraction? Is a V-shaped recovery really realistic? Most of the companies directly impacted by the lockdown already have huge levels of debt, and there's no guarantee that they can come out of this alive. And if they can't, will the government really bail them out? I mean, these companies aren't the banks, and if they did bail them out, would they ever really offer long-term returns to shareholders, or would the government just turn them into zombie companies? Howard also talks about the oil price war between the Russians and the Saudis, and how this is just another knife in the side of the US economy. While many consumers and companies will benefit from a drop in oil price, a lot of Oil producers in the US absolutely will not. Big losses for these high cost producers means more job losses. It means less capital expenditure, and it means that ultimately US is far more reliant on foreign oil than it was before. All these things are not good for the US economy. On top of this, we have massive stimulus by the government and the Fed to keep the economy functioning. Sure, they can print enough checks to replace every worker's lost wage and to replace every company's lacking revenue. But people still need to be able to buy things in order to stimulate the economy. And if there's no goods or services being produced, then how can all this stimulus keep the economy functioning? People are going to hold on to money like they do during and after every crash. People are afraid to spend. And if they're not spending, and if there's a lack of goods and services being produced for people to buy anyway, then how can replacing every worker's lost wage keep the economy functioning? Lastly, what's the effect of pumping trillions of dollars into existence? Are they just going to devalue the dollar further? Seeing as all other countries are essentially doing the same thing, do we all debase relative to each other? Like, how much inflation is all this printing really going to cause? And might the supply shock stemming from a lack of goods and services drive prices even higher? As you can see from Howard's bull and bear case, there's a lot more potential scenarios on the bear side than on the bull side, leading us to believe that the market potentially has a lot further to drop than it already has. But what does all this mean for us as long-term investors? Well, again, I'll refer to Mr. Marx when he says that the future is unknowable. It is now and it always has been. The question then that we must ask ourselves is, should we be buying or not? And where should we be positioning ourselves in terms of risk and defensiveness? As always, there's a spectrum of how risk averse we can be. And it's up to us as individual investors to decide where on that spectrum we want to position our portfolios. Well, certainly if we go back to this time last year, we were clearly at the end of a massive bull run. And at the time, equities were priced in such a way that the market was expecting past performance to carry on into the future. At the time, we should have been moving into a defensive strategy, because we know that the likelihood of uninhibited growth continuing on into the future is very low. And in hindsight, taking a more defensive approach was obviously the correct decision to make. And now then, the market is pricing in a future that's far more unpredictable. Fair enough, we could debate the level of uncertainty currently priced into the market, and if it's enough considering the situation we're in. But it's certainly pricing in more uncertainty than it was this time last year. And we know that with uncertainty always comes opportunity. Does that mean that we should go all in on equities? Well, probably not. But does that mean that we should refrain from buying at all? Probably not either. We cannot predict the top or the bottom. So all we can do is buy where we see value and remain liquid enough that we can continue to capitalise on opportunities should more of them arise. I think we should also be preparing ourselves for both inflation or deflation. The massive spike in unemployment is going to leave people with less currency to spend, and it's going to leave them fearful of spending the currency they do have. This is going to have a deflationary effect on the short term. Then I think that there's a high risk of us seeing this followed by inflation. You see, deflation is every central banker's worst nightmare. With rising deflation, the already massive burden of debts on companies and countries gets far worse. You see, the central banker's number one job is to maintain inflation at 2%. And historically, in the last 20-30 years, they've done a very good job at doing this. But now, with such deflationary pressures coming at us, they're going to throw every tool in the box to keep deflation at bay. And they're going to print money like it's going to go out of fashion. We're already seeing this play out right now. And let me tell you, there is no such thing as a free lunch. Every cause has an effect. And we will see an effect from all this money printing. But the truth is, nobody really knows. And anybody who tells you they do is not worth your time or attention. So we must be prepared for all scenarios. Personally, I'm staying invested in stocks, and I'm continuing to invest where I see value. By buying real assets, I'm protecting myself against inflation. I'm also staying liquid enough that I can continue to capitalise on further opportunities as they arise. I mean, remember, we're only just coming into earnings season and we're likely to see some great opportunities arise. Anyway guys, I hope you enjoyed watching this video. If you did, then hit the like button and subscribe to the channel and hit the notification bell. Also, let us know in the comments below what you're doing to protect yourself and to make the most out of this opportunity. Thanks for watching and have a lovely day.